The content discussed in this podcast should not be construed as a recommendation to invest in a security or investment strategy or tax advice. Investors should consult their own tax professional.
Hello, and welcome to this latest episode of the Friends of Sanctuary podcast. I'm Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. Today, I'm pleased to welcome our guests, Zach Ullrich, Managing Director of Direct Indexing at First Trust, and our very own Richard Williams, Managing Director and Head of Advisor Solutions Group at Sanctuary Wealth. Zach and Rich, thank you so much for joining me here today.
Oh, good to be here.
So Zach, I'm going to start off with you. We're going to be talking about direct indexing. I've been in the business for 40 years. And when this topic recently came up, I had never heard of direct indexing, which I found pretty odd because I've worked in the wealth management industry for such a long time.
Sure.
Can you explain to our audience what is direct indexing from kind of like a high level, because we're going to be going into more detail in our conversation?
Happy to do that. So as the name implies, direct indexing is direct ownership of a particular index. And the reason that there is a difference in that description from what most are familiar with is most investors today are familiar with a way of index investing, which would be through a traditional pooled investment vehicle or a fund. An exchange-traded fund that owns the S&P 500 stocks. They would own an individual ticker whose value tracks the S&P. It may also own a mutual fund to access that same index. With direct indexing, the investment vehicle that's being used is not a fund. It is a separately managed account. The benefits of a separately managed account is we're shredding the wrapper, the product wrapper, and the individual investor is going to own the actual underlying stocks whose collective value directly tracks the performance of an index. And there are a number of different benefits to that shredded wrapper, separately managed account, direct ownership of an index that I'm sure we'll get into.
So when we were chatting, you had told me direct indexing has been around for about 30 years. And again, that shocked me because I've never heard about it. Why today? What has changed that has allowed direct indexing to really now come into the wealth management industry where it can benefit accounts?
Sure. Well, there's two key drivers of why we're having this conversation today and why there's been so much publicity around direct indexing, even though it has existed for many, many decades. The two main input costs to direct indexing have come down substantially in the last several years. So 10 years ago, direct indexing existed. It was primarily only available to ultra high net worth individuals with very, very large individual accounts. But those two main input costs that have come down substantially, main of which is most custodians for equity trades charge zero at this point. So if you've got a strategy with high turnover, a stock strategy with high turnover, and there's no cost to the trades on those stocks, that's obviously a substantial input cost that has effectively gone away in most situations. The other input cost is the cost of technology. There's a big underlying component to the direct index SMA that is technology-based. And in the last several years, the quality of that technology has enhanced quite a bit. The cost of that technology has come down as well. So with those two input costs coming down so much, we're now in a situation where we're not just having this conversation with those ultra high net worth individuals. We're having this conversation with many investors who have a need for focusing on after-tax benefit or who have an interest in customizing their portfolios as well.
So Zach, I'm sure you get this question. There's exchange-traded funds known as ETFs, there's mutual funds, and there's direct indexing. How should an advisor or client think about those different categories?
So the exchange-traded fund and the mutual fund, those are pooled investment vehicles where an individual investor is going to own a share of that particular fund. Financial advisors are using exchange-traded funds, they're using mutual funds. In a lot of ways, from what we've been able to gather, primarily to focus on generating investment alpha around the core of their equity portfolio. So for example, you've got exchange-traded funds that can quickly give you access to multiple different sectors of the marketplace. So you've got a financial advisor who likes technology at one point in time, they like financials at another point in time. Exchange-traded funds give advisors the ability to tactically move amongst those different product vehicles in a nimble way. Where direct indexing is fitting next to that type of activity is to be that anchor to an overall asset allocation where investors want to access a particular index or a mix of indexes. And then in accessing those indexes, but then unlocking some of the tax benefits from the direct index SMA that we'll go into a bit of detail on here shortly. Unlocking that tax benefit helps to offset any taxes that might result from those tactical decisions that are being made in the satellite portion of a portfolio where there's some trading of, in this example, potentially some exchange-traded funds.
Like, for example, with mutual funds, the advisor can't control that tax loss harvesting. It's the portfolio manager that's doing that.
Correct.
Right? Okay. Rich, have you started to see adoption of this strategy? Is it well adopted? Is it in the early stages?
So it is in the early stages in the retail space. So as Zach mentioned earlier, the institutions have primarily been the ones for the last 30 years who have adopted the direct indexing strategy. But with technology and trading, Zach's absolutely right on that. It's allowed these sponsors or these managers to deliver direct indexing to a more broad audience. Within our company, within Sanctuary, we do have multiple advisors who utilize direct indexing as a core part of their portfolio. And as Zach said, hang around that core satellite managers and product in order to fulfill a client mandate.
So do you have some use case examples?
Oh, absolutely.
That you can mention?
Absolutely. There are multiple use case examples, and I'm going to share this answer with Zach. I'll touch on the ones that are most popular to Sanctuary. I see the most popular being the ability to disaggregate a mutual fund or an ETF and still replicate the return of the index that security, that ETF or mutual fund is meant to track, but do that in a UMA or an SMA, either one, a separately managed account, and reap the benefits of the tax loss harvesting that the program, the technology can generate. The second use case I've seen that's prevalent in our company would be the ability to transition out of a highly appreciated asset. So let's use NVIDIA, for example. It's been on a nice run this year, and that was an excellent call that you made, to on that particular company. But so say it's a large position of your portfolio. It's highly appreciated. It has gains in it, and you can use direct indexing to harvest losses in other parts of your portfolio to reap some of the gains within that highly appreciated position, and over time work to rebalance your portfolio such that an individual name is not a material or too large a percentage of your holdings.
So the advisor controls that, not someone else. Is that correct?
The advisor can control that through the setup of the SMA, of the separately managed account, in conjunction with working with the sponsor or the portfolio manager. They can implement what we call a capital gain budget. So for example, if your capital gain budget is $25,000, then the sponsor or the manager will maintain that maximum gain throughout the course of the year, but that still doesn't prohibit them from actively trading the portfolio. As multiple positions in the portfolio change prices frequently, they can harvest losses, take gains up to that cap, wait until there's more losses, harvest, and still maintain that cap gain.
So Zach, there's a lot going on in direct indexing. So let's really kind of boil this down and go maybe step by step as to some of the benefits of direct indexing. So I'm hearing a lot about tax loss harvesting, taxing. What other efficiencies, or do you want to just bucket what are the tax efficiencies within direct indexing?
Happy to do that. So at the start, we talked about we're shredding the wrapper. So the individual client is going to directly own the index because they're going to own the underlying stocks whose collective value tracks the S&P 500, for example. So the main benefit there from a tax perspective is the portfolio manager has the ability to look at all of the stocks that are owned on a daily basis and identify opportunities at a given point in time where a certain stock is down at a loss, and that portfolio manager can go in and take that loss, capture that tax loss carry forward, and flip the proceeds into a like security. Mm-hmm. So a simple example is if you've got a 300 stock S&P 500 equivalent direct index SMA, and within that 300 stock portfolio, you've got Coca-Cola that is sold off 15%. Well, at that given point in time, the portfolio manager would make a decision to say, let's sell Coke, take the loss so that we can use that future tax loss carry forward to offset a capital gain, and we'll flip those proceeds immediately into Pepsi because Pepsi has a high enough correlation to Coca-Cola, so there's a substantial tax benefit that does not disrupt our index tracking goal, which is a key part of the direct index SMA. On a pre-tax basis, if the mandate is the S&P 500, then the pre-tax performance is going to align within a tracking error budget to the S&P 500. And then over time, all of those opportunities to sell Coke go into Pepsi, sell Lowe's go into Home Depot, sell Merck go into Pfizer. Those are going to be the opportunities that the portfolio manager is taking advantage to maximize that after-tax outcome for the individual client.
And when we were talking, you were talking about how many stocks were down 5% last year. You know, we had great gains, but a handful of stocks really only provided that gain. And there was a lot of activity going on underneath. So I'm sure with direct indexing, there was a lot of opportunity to do things within that index. Am I correct?
Last year is a really great anecdote for the benefits of direct indexing. So the S&P 500 last year was up 24%. So if you, as an investor, January 1st of last year, bought an S&P 500 exchange-traded fund, you would erode that 24% up S&P year. It's great. Take that same exposure and own it through a direct index SMA, and you're going to get that 24% inside your tracking error budget. But then along the way, in a year like last year, 65% of the stocks in the S&P 500 in an up 24 year actually had a drawdown greater than 5%. So you have all of these securities where we as the portfolio manager would be able to go spin those losses on the back end while simultaneously delivering that near index return, which creates that tax alpha benefit, which is an industry term to measure how much benefit are you getting from all of those tax loss harvesting activities that we're creating within the account if you're using those to offset capital gains elsewhere within your financial profile.
So the next question is, so it offers you then flexibility? Is flexibility part of the benefits of direct indexing?
The flexibility that the separately managed account direct index strategy provides is really one of the most exciting things about the product. We spent a lot of time talking about the tax benefits, and those certainly are abundant. The flexibility of the direct index SMA extends into customizing a portfolio. So, for example, you may have a client who has a concentrated business interest in a particular sector. Maybe it's technology, maybe it's financials. And because they have so much exposure through their business interest, they might look at an S&P 500 direct index account, but instead of having exposure to technology within their S&P 500 direct index account, they may strip out that particular sector because they have so much concentrated business interest. We call that a completion portfolio. So we can also apply that to individuals who potentially have concentrated stocks in a particular sector. For the last several years, we've all been hearing about the Mag 7. Many individual investors have rode that wave, and it's been really beneficial to their overall wealth profile. Well, if an individual investor has a large concentration in the Mag 7 and they have some cash, we could create a completion portfolio where we're working around those particular companies to fill out the rest of the allocation so they get the diversification that we can provide, and then potentially tax loss harvesting along the way if that investor would like to divest some of their concentration from those particular stocks as well.
I think that's a really key, important point, especially with concentrated stock risk, especially, as you said, with some of the larger companies.
That's exactly right. And that's a common use case that we're seeing, as Rich alluded to earlier. So tax losses benefit you when you're offsetting gains. So if you've got that concentrated stock position and you want to set a capital gains budget of $25,000 a year, we're going to run the account to generate the appropriate losses so that we can divest from that position without taking more than $25,000 in capital gains in any particular year.
So how do you compare this to actively managed? Because this sounds like there's a little bit of activity going on. So how do you contrast this to actively managed accounts?
So actively managed accounts are going to have their place. You may have a large cap value manager who's a great stock picker. They're invested in dividend growth type companies, and that's still going to be very relevant. Where this is complemental is that active manager is going to make active decisions all of the accounts that they manage. So they're going to make a decision to sell a stock and buy a new stock, and that's going to have tax implications. So next to those types of active strategies would be this active direct indexing strategy that has a focus on index returns plus generating all those losses so that those losses can be used to offset the gains that an active manager may be generating through their strategy. So on net, it makes the whole portfolio better from the perspective of we are focused on generating alpha through some active selection while also minimizing taxes through a direct indexing strategy, the combination of which is very powerful.
So if I kind of wrap this up, it also sounds like you have cost benefits to this based on what we've been talking about. Is that correct?
Certainly. There are certainly cost benefits to investors. And there's actually a study that was put out by Ibbotson. They did an analysis back to 1926, and they were looking at the cost of tax drag to an individual investor. When you look at back to 1926, you look at a large cap index, you've got about an annualized return around 10.1%. The analysis that they did quantified the tax drag over that time frame of about 320 basis points.
That's pretty significant.
Tax drag. So in terms of cost, the last several years there's been so much focus on advisory fees, fund expenses. The most substantial cost to an individual's long-term wealth profile, in our view, is taxes. So to have a centerpiece of the overall asset allocation that is hyper-focused on minimizing that tax burden has a substantial cost benefit to individual investors.
So, Rich, you said earlier that this is really early stages, not well adopted. Do you know why? That's a natural. Why haven't advisors embraced this strategy?
Well, they are embracing, but in all honesty, it hasn't been available at the retail registered investment advisor level for 30 years. It's been available for 5, 10. As the cost of trading has come down, as Zach mentioned, the per share cost a custodian will charge you to settle a trade, and the cost of the technology for the sponsors to deliver a direct index at a lower minimum, right? So institutional land minimums were $1 million, $5 million. Most retail investors don't have that as a percentage of their overall portfolio to invest. So the technology has allowed, and the change in pricing at the custodians for share trades has allowed these sponsors or asset managers to reduce the minimums at which they can accommodate this strategy for retail advisors. We see minimums in some instances as low as $100,000. We see some at $250,000. We see some at $500,000. But it is now opening up to a much broader universe of the retail investor base to be able to access a direct index strategy as a part of an overall portfolio, not an entire portfolio.
So, Rich, this sounds like the democratization. That seems to be the new industry buzzword. So, where a product now is available to the individual investor. So you would agree with that. So what advisors, how do I want to say this? Who should really consider this type of product in a client portfolio?
Literally any advisor for almost any client type that has enough assets or enough investable assets to incorporate direct indexing as a component of an overall portfolio. Or in theory, it could be 100% of a portfolio. So as we've talked about this, Zach made the comment, S&P 500, but then mentioned 300 stocks, right? You can replicate the performance of the S&P 500 using a subset of the securities that are held in the S&P 500.
So you don't need all 500.
So you don't need all 500 stocks, which also allows then for the trade-off to buy and sell like securities. You mentioned Coke and Pepsi. The second part of why it's appropriate is you are going to receive, within a margin of error, the return of the index that you select to have your account managed against, whether it's the S&P 500, the Russell 1000. There are international indices that are available, plus your ability to customize within that to either exclude securities, exclude sectors, if you have faith-based initiatives, to exclude carbon or any other restriction that you may have predilection to exclude. So when you combine all that together at $100,000, $250,000, $500,000 account size, you can generate the return of the index, but within the preferences that you select on how to generate that. So now that it's available to a much broader array of the universe in the RIA space, it is without a doubt suitable for any client that has an equity exposure, highly suitable for those that are in a higher tax bracket because you get more benefit from the losses that are generated. But regardless of that, you can get an index return customized to kind of your preferences.
So I like this idea of customization designed for what the client is trying to achieve. So it sounds like there's a benefit for advisors to differentiate themselves. Would that be correct? How does an advisor use direct indexing to maybe differentiate themselves from others?
That's an excellent question. So we did a little study internally and asked our advisors, how many of you use direct indexing? Now, let's say 20% of our advisors raised their hand. You were at this sample. And I said, how many of you don't know what direct indexing is? And 70% raised their hand.
And we have very smart...
We have very sophisticated advisors
that have been doing this for a long time.
So that proves the point that it's newer to the industry. So we've done an enormous amount of education on how to implement the appropriate instances with which to implement. Most clients in the industry at large are not aware of direct indexing or the benefits that it can provide. Fair statement?
Mm-hmm. Fair.
So we've taken it upon ourselves, which while we're doing this podcast and other things that we've done, is to educate the advisor base, educate the public for that matter, an opportunity that they have available to them that's highly customizable, that generates an index-based rate of return, and is a suitable replacement for a mutual fund or an ETF within a portfolio, either holistically or as a component thereof.
Okay, I'm sold. I really like this idea of being able to customize a portion of a portfolio, or you could probably customize a whole portfolio, I'm assuming. So Zach, can you walk us through, if an advisor wants to use direct indexing, what's the process? Do they choose an index? How do they choose an index? Can you just walk us through that process of getting it implemented into a client's account?
Sure. The process is fairly simple. There's some onboarding documents on the front end, but at which point those are complete. It's really just a matter of selecting the index or combination of indexes that the advisor wants to implement on behalf of the client. From there, we will work with the advisor. We've got an intuitive user interface that allows the advisor to then click button, customize the portfolio for the individual. And I use that word click button because within the user interface, we've got tiles to express a particular religious preference. We've got tiles that allow an individual investor to select the different values that they want to impart on a particular portfolio. If they want to remove carbon, things of that sort, you can just click those things.
Tobacco, guns,
alcohol, firearm.
The sin stocks, as they call them.
Exactly. We make the joke, we're here in New York, we're talking about how there's 4 presidents in town. You can also, whether you watch MSNBC or Fox News and you want to express those political values, you've got ways in which you can strip out companies based on those particular parameters as well.
So you can basically create your own index.
You can create your own index. Correct.
So let's just summarize this. So take direct indexing and just list the benefits, all of the benefits. You get tax advantage, cost savings. I would say some efficiencies in there. What else am I missing?
Well, yes, the tax advantage piece is really important. And I want to go back to something that Rich was mentioning earlier about, is this new? Direct indexing in its current form is becoming new to a lot of retail investors, but index investing is not new. But it was fairly new if you go back to 2006. 2006, the ETF industry was in its infancy. At the time, you had an ETF industry that was around $400 billion in 2006. Today, the ETF industry is an $8 trillion marketplace. The ETF product has captured a lot of market share from the legacy, more traditional mutual fund product. And the reason for that is many investors sought ownership of a particular index, and they used the exchange-traded fund to do that. The reason they chose the exchange-traded fund to do that is because the ETF had some tax efficiency benefits relative to the traditional mutual fund.
And you can also trade it all day long. You can't trade a mutual fund all day long.
Exactly. And that's another key part of the ETF product structure. So now we're at a point in time where investors are familiar with indexing. They've gotten familiar with it through the exchange-traded funds. And now we're here where there's an understanding that, I can get my index plus all of these other benefits. I just have to do it through a separately managed account. And so in a lot of ways to us, it feels like we are in the direct index SMA space, a lot like where we were in the ETF space back in the 06, 07, 08 timeframe, because there's going to be a lot of education into the retail market, into the advisor market. And I think that there's going to be a tremendous opportunity for the advisors and the advisors' clients who seek out to understand these benefits and begin to implement what we believe is a more efficient way of indexing.
It's a growing industry. It's early. Do you have estimates of how much money is now in these customized direct indexing and maybe where some of the projections are going over the next 3 to 5 years?
Cerulli has been really at the forefront of a lot of the industry research. They're right now forecasting a 12% annualized year-over-year growth rate for direct indexing, which is much larger than exchange-traded funds, mutual funds, traditional SMAs. So the growth forecasts are robust. I think one of the data points that we anchor ourselves to when we're looking at the market opportunity is when you look at the index tracking equity ETF market. And within that market, you look at the low turnover index tracking equity ETFs, which would be your S&P 500, your Russell 1000 ETFs. That's about a $3.6 trillion marketplace. And so most of that $3.6 trillion has allocated over the last 15 years. So now we're here at this point in time where the question is, where will the next $3.6 trillion go when investors have a choice? I can own my S&P 500 ETF, or I can own an S&P 500 through a direct index SMA and unlock all of these other benefits. So we're making a simple decision to focus our resources here because it's our view that the next 3.6 trillion, much of it for taxable investors or those that want customization, are going to choose the direct index SMA.
Well, that sounds like a very good growing business. So, Rich, as you've been educating, we call them our partner firms, our advisors, about direct indexing, what's some of the feedback you're getting?
The feedback's really been quite supportive. They're intrigued, let's put it that way. So I've heard direct indexing referred to as the ETF killer, right? So ETFs kind of cannibalize mutual funds, and I've heard direct indexing called the next evolution of ETFs, or the ETF killer to an extent, right? And
I'm going to interject here for a second. I was fortunate enough to be the first person on Wall Street to be allowed to put ratings on exchange-traded funds. So I understand the ETF business. And yes, it's a very big business, but you're not talking about mutual funds, right? ETFs got a lot of their money from the mutual fund. This also sounds that this is going to not just be competitive with ETFs, but it's also going to be competitive with mutual funds. And that's also a multi-trillion-dollar asset class. Would you agree with that?
That's certainly true. And with what we've observed with what the ETF industry did to the broader mutual fund industry, direct indexing is just going to be another outshoot of that.
right.
Where we think that direct indexing is going to be most acutely disruptive is to the passive ETF market. The exchange-traded fund structure is one of the most significant advancements in the last 30 years in financial services. Within the exchange-traded fund structure, where we think the value is going to be more clearly understood about that structure is for your high turnover strategies. So within an exchange-traded fund, you can change the securities in a way that's really tax efficient relative to other structures. But the direct index SMA, in our view, is going to apply the most pressure to that passive ETF market, because if the ETF is not turning over a ton, the benefits of the ETF structure are less significant. Therefore, it makes it more clear that the better vehicle would be the direct index SMA.
The more tax efficient vehicle.
Exactly.
So, Rich, you talked a little bit about the amount of money. You've talked about 100 to 500,000. Do you have at First Trust a minimum in order to implement a direct indexing product in a client portfolio?
Through Sanctuary, we have a minimum account size of 250,000. Average account size has been much larger than that. The $250,000 to $500,000 accounts that we're seeing are oftentimes, we'll call it that young professional who has just got started investing. They've got their first $250,000 to $500,000 of taxable assets that are invested in core equities. And that's actually one of the most powerful use cases, because that type of investor, that doctor, that lawyer, that tech professional who's in their high earning years, they've got that base. And then over time, they're going to continue to add cash into the account, whether that's $10,000 a year, $50,000 a year. And the reason that's so powerful is because what you're doing within the account is you're adding in fresh cost basis. And what that provides the portfolio manager is dry powder to spin that tax loss harvesting machine. So you get this really powerful dynamic of maximizing that after-tax outcome when you've got an account that gets started and has regular cash infusions. And so those types of professionals we see quite a bit in that account size threshold.
Something that just came to my mind, that investor that's been around for a while, that's already established their wealth, a lot of those clients want to get income and generate income. We haven't talked about income. Is direct indexing, do you have products or indexes that can help clients actually get cash flow into the portfolio?
So the benefit of direct indexing for an investor that's in the withdrawal phase of their investment life cycle is going to be, there are going to be oftentimes many streams of income that investor is drawing off of. Of course, with municipals, they're going to be tax-free, but there's going to be other streams of income that do have some tax implications. So to have a tax loss harvesting piece of the portfolio to offset taxes from some of those income streams that do have a taxable structure to them, that's going to be where that individual is going to feel the benefit most, is in offsetting some of the taxes from the income streams that they have.
Oh, that's interesting. I didn't think about that. So Rich, when you're talking to advisors, like what's the number one question you get?
So the very first question that you ask, Zach, how does it work? What are the benefits of it? And in what use cases can I apply it? Right? Those are the top questions. Once you explain how it works, then the question becomes more pointed. Oh, so should I use this as a core holding and build a portfolio, satellite portfolios around it? Should I use it as the only holding? And then that really comes down to client preference and where the client is in their investing life cycle. The most recent question I've had is from one of our longer users of direct indexing, which is we've had this client invested in direct indexing for a number of years now, and we don't have any more losses to harvest because the markets have risen so much over the last 3 years, 5 years. So I know, Zach, you got a question, you answered that question for us. And the answer was, well, now you can start using options overlay to generate income off the portfolio and then protect against the downside as well, if you want to expand upon that or not. So there's a natural evolution to it, but the initial questions generally are, what is it? How does it work? And what are the benefits of it? And how do I implement it? And it's generally a fairly short conversation. They grasp the concept. And really the beauty of direct indexing is if you have $10 and it's a taxable account and you generate gains and you have to pay $2 in gains, now you have $8 left to invest. If you can generate losses that offset that $2 in gain, you still have $10 to invest. You've matched the index, but now your corpus or your basis is larger and can grow faster. And once advisors understand that concept and how leaving money in the portfolio to compound because you've mitigated tax liabilities or tax offsets is a really powerful tool, not only for the advisor, but for the client.
Zach, do you want to address that? That's called call overriding, right? Bringing in that premium to generate income. Do you want to comment at all on that?
Yep. So we're at the 1 yard line with incorporating a suite of options capabilities with Sanctuary. And where those options capabilities are going to be most additive is in the context of this direct indexing conversation, to Rich's point. If you've got an account that has been around for 6-7 years and the market's gone up, you've built this bank of tax loss carry forwards, but the majority of the portfolio is sitting at a gain. So there's not much tax loss juice left to squeeze. So at that point in time, and also think this through, if you're an individual investor and you're 55 years old and 7 years later, you're 62, you're now retired, you've got a completely different investor profile at that point in time. So you may at that time want to start generating some income off of your large cap core allocation. So at which point we would be able to incorporate a call writing strategy to generate a certain target yield on the portfolio. Or you may not need to generate income from your equity portion, but you're more concerned about capital preservation, at which point we can start writing in, buying in protective puts on the portfolio. So options are such an exciting security that, a lot like direct indexing, have not been widely adopted by the retail market. But there are so many things that you can do with options inside of direct indexing to create unique outcomes for clients, and fitting them within the direct indexing conversations is one of the other things that we're really excited about.
So what I'm gathering from this conversation is an advisor can contact you and your team and really sit down and have a conversation and talk about client needs to be able to figure out what would be an appropriate direct indexing product in a client portfolio. Am I taking away that correctly?
That's one of the most exciting things about what we're doing, is the ability to roll up our sleeves and solve complex problems with our financial advisor clients who are working on behalf of their retail clients. And we've got a lot of different tools to do that. And they're they're flexible tools, they're exciting tools, and that's where it really gets interesting, is when we really get to add value through the solving of those complex problems.
This has just been a really insightful and wonderful conversation, and we've talked about a lot, but I'm going to ask each one of you, what haven't we talked about? If there's something we haven't talked about that you think that our audience should know. And Rich, I'll start with you.
So we touched on, but I don't know if we fully plumbed the various use cases. So as an advisor or a client is listening to this podcast, what are the 4, 5, 6 situations I find myself in where I can discuss with my advisor, or as an advisor, I can discuss with my client direct indexing as a suitable solution or option for that, right? So we rattled off concentrated positions, we rattled off shredding the wrapper around ETFs and owning the underlying securities and establishing your own cost basis on those to drive the tax loss harvest on direct indexing. Another one, Zach, and I'm going to lean on you for this answer, but is let's say you own a business and you plan to sell it in the next 3-5 years, and it's going to be a significant capital gain associated with that. You can borrow against that business. You can put money into an account and you can start generating losses, right, in advance of that particular transaction to help offset some of the capital gains that would occur at the point of that sale. Zach, there another one or two you would throw out?
That's one of my favorite use cases. Is you've got a client or a prospect who has a liquidity event at some point the next couple of years, and they've got some cash. Taking that cash and super funding a direct index SMA to prepare for that future capital gain. This is one of the most valuable use cases that we see for end investors and also for financial advisors who are looking to differentiate, to have some type of exit planning strategy that they're comfortable with, is a really relevant way to be relevant to those types of investors, which have really complex needs, and we've got solutions that can help to minimize those capital gains implications.
So Zach, I'm going to ask you the same question. What haven't we talked about that you think our audience should be aware of that we haven't talked about?
Sure. I think that the value of high quality advice has never been higher. And I think that is an important statement to make, because I can go back to a time, 2015 through 2020, where there was all this chatter about the disruption to the financial advisor because of robo-advisory platforms. Make a phone call, download an app. And I think what we have come to learn at We First Trust, we sit tucked in the advisor ecosystem, is we've come to learn that with all the tools and technology and things that we've talked about here today, the tools in the toolkit of the financial advisor have never been more robust. And I think that's just an interesting comment in the context of a lot of the chatter that we've heard over the last several years. But the value of a quality financial professional has never been higher.
And I can validate that. As many people know, I worked at Merrill Lynch for a very long time, and we did a lot of surveys. And what we found is the younger generation may want that robo-advisor, very early stages in their investment cycle. But once the client starts building wealth, they want to sit down and talk to somebody. They don't want to talk to a computer. They want to be able to do and maybe their own research, but at the end of the day, that one-on-one conversation, they want to talk to that person that can help manage where they're putting their assets. So I can validate that even the clients themselves are saying that they want to talk to somebody. And as you correctly pointed out, the tools that advisors have today are very, very robust. So I want to thank both of you gentlemen for being here today and educating us on this wonderful new product called direct indexing. And I want to thank all of you for tuning in.
Thank you for watching or listening to the Friends of Sanctuary podcast. Tune in next month to be sure not to miss out on the next installment of the series.
Securities offered through Sanctuary Securities, Inc., member FINRA, SIPC. Advisory services offered through Sanctuary Advisors, LLC, an SEC registered investment advisor. Sanctuary Securities, Inc. and Sanctuary Advisors, LLC are wholly owned subsidiaries of Sanctuary Wealth Group, LLC.